Welcome to Lesson 5, the second of 3 videos for our topic on taxes. Well, there's no getting around it. The U.S. tax code is very complicated. There's no way to make you an expert in 1 lesson, 10 lessons, or even 100 lessons. Nonetheless, in this lesson and in Lesson 6, we'll point to a few provisions of the tax code that are of highest interest to most taxpayers. As we discussed in the last lesson, tax rates are defined by taxable income and the type of taxable unit. In other words, your filing status. The tax rates are progressive. This means that the greater your taxable income, the higher your tax rate. So let's look at an example. Let's take a married couple with a taxable income of $50,000 per year. Remember, this is after deductions, exclusions, etc. This couple owes taxes at a rate of 10% on the first $17,400 of their income. This comes to $1,740. Now, let's move on to the next tax bracket. Then they'll pay 15% on the difference between $17,400 and $50,000. This is 15% times $32,800, or $4,920. So this amounts to a total tax bill of $6,660. As if the tax code is not difficult enough, different types of income are taxed at different rates. The typical tax rate shown earlier on the previous page is the tax rate on general income and is sometimes referred to as the earned income rate. There are other rates for other types of income. Generally, these rates deal with investment income. The dividends paid by a company are either ordinary dividends or qualified dividends. Taxes on qualified dividends are paid at a special flat rate. The profit when you sell something for more than your calculated purchase value is called capital gains. They are subject to their own special rate table. Let's look at a few items pertaining to gifts and inheritance. As you can see, the recipient of the gift pays no taxes on the gift generally. The giver of the gift may incur taxes under the estate and gift tax rules. Don't forget, the gift retains the basis of the giver or the donor unless the property was sold at a loss. Depreciation is the system by which a business can expense capital equipment as an ordinary business expense. For example, if a business buys a truck, it is only allowed to claim the expense associated with this purchase over time. If the business sells the truck, the basis on the truck is reduced by the amount the business took as an expense. Depreciation is a factor that affects capital gains income. Let's look at capital gains on the sale of your house. When you sell your house, you can exclude up to $250,000 in profit from your taxable income if you're single, or $500,000 for a married couple. There are certain exceptions around this, so be sure to read up on this if this pertains to your situation. Let's briefly touch on the Alternative Minimum Tax, or AMT. In 1969, during an era in which much was made of the wealthy paying less taxes than others, the United States Congress enacted a parallel tax calculation with greatly reduced deductions and a separate set of tax rates to reform the inequities in place at the time. This was instituted before the high inflation of the 1970s, when much of the tax code was indexed for inflation. The alternative minimum tax was not indexed, And so now many middle-class families are potentially subject to this burden. For years now, Congress has enacted annual patches to the original provisions of this law. The deductibility of home mortgage interest is certainly a favorite of many Americans. But as with all things tax-related, it's not as simple as it sounds. The interest that is deductible is acquisition and improvement debt plus $100,000. So, if you had paid down your mortgage to $50,000 and then borrowed $125,000 to pay off your credit card or your car loans, the interest on $25,000 would not be deductible. Given all the moving pieces in the tax code, it is little wonder that there are ways you can reduce your tax bill. These 5 Ds will help you look for ideas. Let's take them one by one. Deductions. Take all the deductions and credits you can reliably take. Keep the receipts that justify them. This is especially true if you run some sort of business yourself. Diversions. Take steps to make investments from which the returns will escape taxation or be taxed at a reduced rate. Some examples are student 529 plans, health savings accounts, and Roth IRAs. The next category is deferrals. Take steps to defer taxes until future years, perhaps with an IRA or employer retirement plan. Next we have deflections. Transfer assets to someone in a lower tax bracket. Transferring taxable college savings to your child may be a good choice. Finally, we have diminution. This is a bit of a catch-all category of ideas that you may pick up in the readings for this week. The U.S. tax code is massively complex, and we have really only scratched the surface. In the next lesson, we'll talk about preparing to file your taxes and how to get help.